All right. Good morning, everybody. This is Mike Rixey. I'm the lead options instructor for NetPicks, and this is our midweek options updates. We normally do these sessions during the afternoon hours, but I had some requests from people that aren't able to join us live. They'd like to see these done every once in a while in the morning hours before the market opens. So I wanted to do one of those here today. Just kind of walk you through some of the preparation that we do on our side, getting ready for a new trading session. So as always, you can ask questions along the way. If you've got questions on certain markets that you'd like us to take a look at, let us know. We are more than willing to help out. The plan for today, I will give an update on where we stand on some of the key index products, give a big picture view of the overall market, and then break it down to some of the individual names. So I'll walk you through some trades that I am looking at, names that are on our radar for the next couple of days as we go into the middle end of the week. All right, so let's go ahead and start out by looking at a daily chart of SPY. I always start out every session looking at this daily chart because it helps us put context around the overall market. It helps us determine how aggressive or conservative we want to be. Do I want to use weekly or monthly options? Do I want to trade normal position size, or do I want to cut back a little bit? Do I want to trade long calls and long puts, or do I want to trade more vertical spreads? A lot of the answers to those questions come from some of the analysis on the daily chart and then also on the internals, which we'll take a look at in just a moment. So again, the daily chart is not a chart that I use to time my entry and exits. It's meant to just provide some guidance on overall market sentiment. I've got a handful of different moving averages on my chart, just a mix of simple and exponential moving averages. And you'll see, the last 2 weeks, really going back to when we started to get some clarity around the elections. I know it's still not completed yet, but I think we all know which way that's going. But you can see that the market has certainly been in rally mode. It went from getting through the elections to seeing a couple rounds of positive vaccine news. The last couple of Mondays, we've seen some headlines hit on the vaccine front, and the market has certainly cheered that news as well. Even though the pandemic is not going anywhere anytime soon, the numbers are continuing to explode worldwide. Markets just continue to brush that aside and continue to rally higher. We are only a stone's throw away from that all-time high, which was made last week. The all-time high at 364.38. Now, a couple things I want to point out. We continue to see lighter volume here. Okay, 66 million shares traded yesterday. I would like to see that number closer to 100 million shares. In order for that to happen, we're going to need to see a pullback here. When we start to get into some of the individual charts, we will see that a lot of these big market leaders, they're extended. They're very overbought. It does not mean we can't head higher from here. It's just if we do head higher, I think it's going to be more slow going. That slow grind to the upside that we've seen the last few days. It hasn't been that panic, get me in at any price type of action. We've just kind of seen that slow, methodical grind higher. Very typical of a low volume, late stage move. Now, with that being said, I am not expecting the market to completely fall apart. I don't fall into that camp of, expecting everything to completely collapse. What I am looking for, if we're going to see a move back up to all-time highs, and if it's going to be a sustainable move, I first need to see a pullback. I want to see us get down and test some of these moving averages. I've talked about this the last week or two. If we're going to get a more sustainable run at the highs, we need to see a pause. We need to see a pullback. That way, some of these overbought markets can build some energy for another move to the upside. If we just continue to head higher from here, the volume is going to continue to contract in all likelihood. And it will typically lead to a new high being met and then an immediate sell-off. I would rather see the pause here first before we head higher into the end of the year. Where would I be looking at for an area of support if we do get some selling? The 8-period exponential moving average, that solid pink line on my chart here, that would be the very first point of reference on the downside. Would love to see that tested. I wouldn't expect us to just completely break through that level. I would expect the bulls to put up a fight there. But that level is currently sitting at 355.56. I would love to see that level tested over the next couple of days. Should that level break, we've got this big air pocket down to the 20-period exponential moving average. That one is down right on 349, just below 349 at the moment. Those are going to be two areas of reference on the downside should we get any selling here this week. If we don't, if we continue to head higher, the next area that we're watching on the upside is again that 364.38 all-time high from last week. I think that's going to be a level, unless we get a drastic pickup in volume, I think that's going to be a level that's going to be difficult to break, at least initially. The ATR, the average true range, which is the indicator at the very bottom of my chart. We've talked about this also the last week and a half, how it continues to contract. We've had a very active market for months now. It's still, even though the ATR has contracted, we're still above 6. That's still a very good intraday range on SPY. I want to continue to see this stay above that 4 to 5 level. I want to stay in an active environment. What we don't want to see happen is have this ATR continue to contract, get down below 4, because we saw that. If you go back the last couple of years, we've seen many stretches where the ATR is so small, there's just not much to do. It's like watching paint dry throughout the day. We want to see this market stay active. And in order for that to happen, we're going to need to see some two-way price action. We're going to need to see some selling here in the very near future. The VIX, volatility, barely hanging on to the 20 handle. We're at 22 here at the moment. We have not broken down below 20 in months. So we'll see if volatility continues to stay at a decent level. I'm very surprised that it has actually hung in there as long as it has, because this market's been super strong. We're up near the highs. But there's still a lot of uncertainty out there with how the virus is going to impact the economy here going into this winter. So we'll see if that 20 handle acts as some support on the VIX. See if we can get another pop to the upside. If we take a look at the internals, keep in mind the market has not opened. So these internals are from the close yesterday at 4 p.m. Yesterday's session, we did have a slightly positive volume ratio on both the NYSE and the Nasdaq. The New York Stock Exchange volume ratio was 1.73 to 1 positive, and the Nasdaq was 1.16 to 1 positive. They're positive, but they're not overwhelmingly so. Typically, when we see a trending day, I want to see that volume ratio at a minimum either +2 to 1 on the upside or -2 to 1 on the downside. This ratio that we're seeing here on both the NYSE and the Nasdaq, very indicative of a tired market, right? What volume we did have definitely favored the upside, but not overwhelmingly so. The advanced decline line on the Nasdaq only at +120. Again, on a trending day, I would like to see that number at least at ±1,000. A +120 reading indicates very mixed markets. It just means we're not seeing across the board buying or selling. Very mixed environment. And again, you'll typically see these readings late stages of a move, either on the upside or the downside. In this case, on the upside. On the NYSE, +386 for an advanced decline line reading. So again, not across the board buying, but there are enough pockets of strength to prevent any type of significant weakness from kicking in. Now, we had one -1,000 tick reading yesterday morning right at the open. There was one sell program right at the open, and then the rest of the day, we stayed pinned between plus and -800. What does that mean? It means we're not getting strong buy or sell program. It's a very muted price action. If we get +1,000 tick readings, it indicates buy programs kicking in. If we get -1,000 tick readings, it indicates sell programs kicking in. What I want to see is clusters of those extremes. And we only had one yesterday. Again, just another sign that this market is tired here. It does not mean this market has to completely tank out. It just means that when we start to take a look under the hood a little bit more, we're starting to see some markets that are extended here. That's why I'm very cautiously bullish in the near term. I would actually like to see price action pull back here and flip things around a bit going into the end of the week. On the 5-minute chart of SPY here in the lower right-hand corner, let me try to zoom out here a bit, load up some additional data. Just going to load up 2 days of data so we can see the open yesterday. So this was the lower open. We had that sell program right at the open, and we actually got 25, 30 minutes of selling right at the open yesterday. And then we spent a majority of the rest of the session trying to rally back higher. We continue to see all dip spot, and that's what happens when you get into a low volume environment. It does not take much to get this market to move. That's why if we can get volume to pick back up, I think that would lead to more of a sustainable move in either direction. So in the near term, what is my takeaway here? I'm still leaning cautiously bullish, but I am looking at some of these overbought markets as opportunities to sell some call credit spreads, to put on some neutral to bearish positions that would benefit from either a period of consolidation or even a reversal to the downside. And I'll talk about that more in just a moment. One other step that I take during the day or during the morning hours before the market opens Let me drag this over to my screen. I like to use forexfactory.com. I don't trade the Forex markets at all myself, but I love to use this site for their news calendar. On the main homepage here, you will see that it will list all of the major economic releases or any type of a news event that has historically produced movement in the market. So it'll tell you, I'm looking for the US dollar related news. We had a couple of 8:30 releases. We had our building permits number and the housing starts number at 8:30. It also color codes these news events. And the color code is based on what those news events or what the economic numbers have produced historically. The yellow impacted reports, they'll cause some movement, but they're not going to be drastic. I'm typically focused on either the orange rated news events or the red rated news events. The red news events have caused pretty big market reactions previously. So don't have any major news events on tap. What would I do with this calendar? I'm just looking for any type of a potential event to cause market movement, right? If I'm going to try to place new trades, I don't want to place a new trade at 9:55 a.m. Eastern when we have a big red rated report at 10 a.m. because that 10 a.m. report could cause a big reversal. I would rather wait for the news to come out before I place anything new. Those are the types of things that I'm looking at around news. I'm not a big fundamental guy. I'm not a big news guy, but I do want to know when those market moving events are coming up. So I do try to check Forex Factory before the open as well, just to kind of get a read, get a feel for what could potentially be a market moving event for that session. All right, so let's go now to the actual charts that I use for my entry and exit points. Everything we've talked about so far is just setting us up for the trading day, trying to determine how aggressive or conservative we want to be. I continue to be more conservative on the upside. I would be willing to get more aggressive if we do start to get some two-way action back in this market, if we can get some selling here over the next few days. When I say more aggressive, what does that look like? For me, it could potentially mean a return to my normal position sizing. It could mean looking at more long puts as opposed to just looking at vertical spreads. And it could potentially mean looking at some of the shorter duration options. Those are all ways that we can adjust how aggressive we want to be. So SPY, we just took a look at it on the daily chart. I'm now moving on over to the 195-minute chart. This is the chart that I use for my actual entry and exit points. We've talked about this chart the last few weeks about how price action has been super, super strong. We tried briefly back last week to break the 8-period EMA. That's the blue and red line there on the chart. We tried to break it, didn't happen, right? I mean, we broke it for a period of a few hours and then we reversed right back higher. That is my line in the sand. If we're going to get anything going on the downside, at a very minimum, we need to see that 8 EMA broken on a closing basis. That's why this chart, I'm cautiously bullish here just based on price action. Now, would I initiate new bullish trades here? I would not. If you're already in a bullish trade, I don't mind holding on because price action is clearly favoring the upside here. But I don't believe initiating a new long trade here is in your best interest. I would rather see a pullback first. What would potentially give me a new short trade? I would need our trend strength histogram down at the bottom. It's the red and blue histogram. I would need that to flip the zero line. I need it to go from blue to red, indicating bearish momentum taking over. It's currently sitting at 2.74. I need to see some selling here over the next few days to even consider a long put position. However, our pulse indicator, it's the histogram up above. It's that red and yellow histogram. Notice the last 4 bars there over the last couple of days have printed yellow. What that indicates is an overbought condition. It indicates prices between a 1 and a 2 standard deviation move on the upside. Doesn't mean price can't move higher. It just means it's not statistically probable. Out of this pattern, when you start to see yellow bars plot, it will typically lead to either a sideways consolidation or even a reversal in the other direction. If we just take a look recently at the last 2 occurrences, actually, let me get my data box out of the way. Look at the last 3 occurrences. Anytime that we've had those yellow bars plot, if we go back into August, we had some yellow bars on the upside. It didn't happen immediately, but notice what happened very soon after those yellow bars started to plot. We saw this nice reversal to the downside. We then in September, we had yellow bars on the downside. We had an oversold condition. Within a couple of days, price action had started to chop, and we did get a nice reversal back to the upside. We then got a similar pattern in late October. Oversold condition, yellow bars on the pulse, and look how price action reversed. It's a very repeatable pattern in many cases. So here we are in real time, price action very extended on the upside. We've had a whole slew of yellow bars on the pulse. I typically want to see 3 out of the past 5 bars plot yellow. That's my minimum. We've got the last 4 plotting yellow here. Look what has happened the last couple of days. See how price action has started to stall out a little bit here near the highs? Very typical pattern. Doesn't mean we have to see a big reversal lower, but you will typically see, at the very least, a period of consolidation within a couple of days of seeing those yellow bars. My takeaway from that, if I see 3 out of the past 5 bars plotting yellow, it has me looking at a potential credit spread opportunity. In this case, I would be open to selling some out of the money call credit spreads here to benefit from either a sideways consolidation or a reversal in the near term. When I say the near term, I'm talking about the next 3 to 7 days. Right? I'm not saying the high is in for the year and we're going to completely fall apart, but in the near term, we're very much due for a pause. SPY is certainly on my radar for a call credit spread. One filter that you have the option of using here is instead of just coming in and selling a call spread now, you could potentially wait for price action to break below the 8 EMA, the red and blue line. I'm fine with that as well. If you wanted to wait for that confirmation, that's fine. You may take another day or two. We'll have to see some selling for that to happen, obviously. But with the credit spreads, I'm not as concerned with timing on those trades. I don't mind if I'm in a little bit early because the time decay is helping us from day one. Anytime that I initiate a credit spread, that time decay is working in our favor from the get-go. So my takeaway here on SPY, the only trade that I have as a potential candidate here is to sell an out-of-the-money call credit spread, potentially with a weekly option or even going out to the December options. Normally, when I sell a credit spread, I'm looking for between 20 and 40 days left to expiration. Over on QQQ, the Nasdaq ETF. A little bit different story here. It has not been near as strong as what we've seen over on the S&P. Over on QQQ, our trend strength histogram down at the bottom is in bullish mode. It's firmly blue, and it's been blue now for the last couple of weeks. But notice how price action has had a very difficult time breaking away from that 290 to 293 range. So we have a lot. I mean, if you start to go in to some of these individual NASDAQ stocks, some of the tech stocks, for example, they're still very overdone. They've had incredible moves to the upside. They're due for pauses, and we're seeing very, very clearly some signs of tired markets. Doesn't mean the NASDAQ has to show a big pullback, but we're very much seeing the start of a pause here. And we'll see again, if we can get a pause, build some energy for another run to the upside going into the end of the year, I think that'd be a very positive sign. At this point, just like SPY, there's no potential for any new long calls or long puts here. If you're already in a bullish trade, that's fine. I just don't want to initiate anything new here at this point. The pulse indicator down at the bottom is also not at an extreme. We do not have an overbought or oversold condition there. No, we're just in a holding pattern on QQQ. Nothing to do there at the moment. IWM, this is the Russell ETF, the Russell 2000 ETF. It also, along with the S&P, has been super strong. The small caps have definitely picked it up. Very similar looking chart pattern to the S&P. Very strong move to the upside, price firmly above the 8 EMA. We do have a whole slew of yellow bars. It's been that way for the last week or so with yellow bars on the pulse. We are at an overbought extreme. This is another potential candidate to sell an out of the money call credit spread. What would that look like? Let's go ahead and just take a quick peek over at the trade page. And let me switch this to IWM. I have been trading a lot of the December monthly options. Those are the options with 30 days left to expiration. Could you trade some of these shorter term weeklies? You could. My only concern there, depending on the product that you're trading, because volume has started to contract, the weekly options don't have near the liquidity as the monthly options. So you've got to keep that in mind. It can be more difficult to get fills quickly and at good pricing on the weeklies. Not a deal breaker, but I just continue to trade a lot of the December options right now. So if we open those up to sell an out of the money call credit spread, I'm going to go to the call options on the left-hand side. And I'm going to start by taking a look at the 183 calls. I went to those calls because they have a 65% chance of closing out of the money. You can see that number right there on the trade page. I would right click on those 183 calls, go to sell, and go to vertical. It's going to pop up an order down at the bottom where I'm selling the 183 call. By default, it has me buying the 184 call at the same time. I'm going to switch that 184 call to 185. The reason I'm doing that, I want to collect more premium. I want to collect more money up front to put this trade on, give myself a bigger profit potential. At the close yesterday, this spread was trading for 70 cents. If I click on confirm and send, it will show that I am collecting $70 per spread. I would be risking $130, right around risk 2 to make 1, a very normal range for us. We're okay with that ratio because we have 5 ways of making money on this position. It is a neutral to bearish position. We make money the fastest if IWM moves to the downside, but we don't need it to. All I need IWM to do is to stay below 183.70. That's my break-even point. And that level is calculated by taking the 183 strike call that I'm selling, adding on the 70-cent credit, and that gives me the break-even. I make money if the stock moves up, down, or sideways. As long as it stays below 183.70, we're okay. We make money from time decay adding up, which it will every single day. And we also make money if volatility continues to decrease. Now I've got 5 different routes to go to make money on the position. The $70 is the most I can make on the trade. So you're looking at that saying that's not a huge profit potential, but you've got to remember, I'm only tying up $130 per spread to begin with. You can put this trade on 10 times, have $1,300 of risk, and now all of a sudden you've got $700 of profit potential over the next 30 days. So you can trade these types of spreads with as big a position size as you want, as long as you are in that 2 to 5% of your account range per trade. Let's just say we get filled at 70 cents here. The only way I can book that full profit is if I hold the expiration. That's not something I typically like to do with a credit spread. I like to close these trades out when I can keep between 50 and 75% of my max profit. So if I can close that thing out between 17 and 35 cents or so, anywhere inside of that range would be acceptable. I'd rather book the partial profit, free up the capital, and move on to the next trade. So IWM, very much on my radar for the next couple of days. Everything I just talked about on IWM, you could follow that same routine over on SPY. They're very similar looking chart patterns at this point. So that is one of the trades that I'm considering. A couple other areas that we have been talking about here in these sessions. The last couple of weeks, I talked about how tech has been very overbought, and I talked about how the energy sector and the financial sector could potentially take the baton from the tech sector. We have very much seen that. Both the financials and the energy names have been super, super strong over the last couple of weeks. If you take a look at XLF, this is the financial ETF. Phenomenal move. I mean, if you go back to the end of October, we've seen a move down from around 23, 25, all the way up to over 28. I mean, that's a big move. Very big move for the financial ETF. We're very overbought. If you take a look at the pulse indicator down at the bottom, not only do we have yellow bars plotting, but we also have green bars as well. And those green bars indicate price being between a 2 and a 3 standard deviation move. We're even more overbought here. Odds favor either a period of consolidation in the near future or even a reversal to the downside. Doesn't mean it has to happen immediately. It just means it's something that's very much on my radar for the next couple of days. A filter that we could potentially use here to see if we are going to get a pullback, wait for price action to get down below the 8 EMA. If it does, this is another one, just like IWM and SPY, this is an opportunity to sell a call credit spread. So definitely one that I'm looking at for the next couple of days. I haven't done anything as of yet. I've just kind of been patient here, waiting for price action to show some signs of a reversal. Notice the last week, we have tested the 8 EMA twice. We tested it yesterday morning. We tested it last week. Both times that level held as support. That level needs to break if we're going to get anything going on the downside. So that's one that we'll take a closer look at, this one again on Friday, to see if we do get a reversal. If it does reverse, I'll definitely be looking at a new position there as well. XLE, this is the energy ETF. And actually, before I get to the energy sector, let's just take a quick peek at an individual financial stock. Let's take a look at Jpmorgan. You start to go through a lot of these financials. I mean, XLF being so extended, it makes complete sense that the individual names are extended as well. Jpmorgan, Citigroup, Bank of America, Goldman Sachs. Those tend to be the 4 financial names that I trade most often. And they're all showing very similar patterns. So if you wanted to use one of the individual stocks as opposed to XLF, you could certainly sell a call spread on Jpmorgan as well. Notice how yesterday we did try to test that 8 EMA again. It was a rock solid support. If we can get a break of that level over the next couple of days, Jpmorgan will be one that I will sell a call credit spread on. Now switching on over to energy. XLE, the energy ETF. Overbought, and just over the past day and a half or so, we did just get some green bars in the pulse. Very overbought on the energy sector as well. XLE, Chevron, Halliburton, they've all had impressive runs higher. These are all names that I'm interested in selling some call credit spreads on. Get some neutral to bearish positions on. Haven't done a whole lot as of yet. I've done more on the energy sector than the financial sector. If you wanted to wait for some confirmation of price reversing, again, use that EMA as a guide. Use that 8 EMA, see if price action can close below that level before getting more aggressive on the downside. Apple, I talked about how tech is pretty tired here. I mean, you can see Apple, it's actually hung in there, but we've just seen a sideways stretch the last couple of weeks. Apple's not a name that likes to stay quiet for long. We've got that coiled spring pattern developing where, when I say coiled spring, we've just been chopping straight sideways. Out of this pattern, we're going to get a break. You just don't know when it's going to happen, nor do you know in which direction it's going to happen in. Obviously, I would love to see price action break lower because it would cause a pickup in volume and allow the range to pick back up. But you can see here the trend strength indicator holding on to the bullish momentum briefly here. So we'll see if we can break the 8 EMA over the next day or two, see if we can get anything going on the downside. If Apple breaks down, that could definitely be the catalyst that we need for that move to the downside that we've been talking about. AMATs, Applied Materials. We talked about this trade last week. This is one that we've been very overbought. We've had the yellow and green bars on the pulse indicator. So we've been super strong. We actually sold a call spread last week. Definitely need some selling here. I need AMAT below 74. I'm short the 74 calls as part of an out of the money call credit spread. So it definitely needs some selling. Nothing huge. That's the nice part about a credit spread. They can recover much faster. They're very forgiving trades. Even though price is moving against me, the time decay is still helping. The time decay is still adding up. If we do get a reversal lower here in the near future, we could see this thing recover much quicker for us, because not only do we have the directional movement in our favor at that point, but we'd also have that time decay continuing to add up for us. So I'm still in my short call credit spread. We sold it last week out in the December monthly options. So I continue to hold that position. No adjustments are needed at this point. I'm just going to continue to hold as is. And then finally, Microsoft. Take a look here. We also talked about this chart last week. We talked about this long setup here. We had our trend strength histogram in bullish mode. We had our entry point here on Microsoft at 217.93. Notice how price action has pulled back. A lot of these tech names have. We're at a very key point here because we're approaching the 50 EMA. That's that white and yellow line. If that level holds over the next day or two, if we bounce off of that level, that could be lead to another leg to the upside. And that could be a sign that tech is ready to take back over the leadership from the financials and energy. I could very well see a rotation back out of the financials and out of energy and back into tech. That's something that I'm keeping an eye on for the rest of the week as well. So Microsoft at a very key point here, testing that 50 EMA. Want to see if that level holds going into the end of the week. Might I ask why you're not using the VWAP? So the volume weighted average price, I love to use it on the 5-minute chart. So if I go back to my internals workspace that I showed you earlier, let me bring it back up here. I love to use the VWAP on this 5-minute chart. That's what you're looking at with that blue line. Love to use the VWAP intraday. On the bigger time frames, like the 195 minutes, it's not that I don't like to use the VWAP. I just prefer to use the 8 EMA, the 8-period exponential moving average. I have just found better results using that level. But again, the VWAP, it's one of my favorite indicators. I love to use it on the intraday charts. So if that's one that you use, I'd say stick with it. It's one of my favorites. Artie, the screen is out of focus. Yeah, sorry, there's not much I can do on that side. Yeah, I don't think there's any settings that I can change here in the room to change the visuals there. Sorry about that. All right. If you have any other questions on markets that you would like me to take a look at, let me know. I've got one more that I want to take a look at, but feel free to type in any other symbols and I'll do my best to pop those up. Chewy. So now that we've got some of the shutdowns starting to pick back up here worldwide, but specifically here in the US, some of these COVID names, if you will, some of these stocks that benefit from the lockdowns and the people staying home and whatnot, Chewy is definitely one of those names. And we've been in a quiet pattern here of late, really going back into September, October. We've had a very messy looking chart. You know, we've seen some pause here. We've seen some chop, building energy for the next potential move. I could certainly see Chewy breaking to the upside from here if we continue to see some of these shutdowns continue. The trend strength histogram just here this week flipped bullish. We have an entry point. I am looking for a move above the 65 level. If we break 65 here on Chewy, this is also a bullish candidate for us the rest of the week. Here's what that looks like over on the trade page. If I switch the symbol from IWM to Chewy, I'm going to continue to look at the December monthly options. I would be looking for a long call. I ideally like to trade the options that are slightly in the money. I am looking at the 60 calls here. They're trading for right around, as of the close yesterday, they're trading right around $7.70, $770 per contract. A little bit more expensive because volatility is still elevated. We also are going out 30 days. We're going out a little bit longer than what we typically do. So they're a little bit more expensive. I don't mind that. This is a way to be a little bit more aggressive. I like to mix up my strategy. We talked about some credit spreads earlier. I love to use a lot of credit spreads, but I also like to mix in the long calls and long puts. The more diversification you can have in your trading, the better your results will be long-term. My split right now in my own personal trading, looking at my overall positions, I'm right around between 75 and 80% credit spreads and 20 to 25% long calls, long puts. In most cases, long-term, historically, I mean, I'm normally 2/3 credit spreads and 1/3 long calls, long puts. So I'm close to that. I love to use the credit spreads because they're more forgiving type trades. And especially in this market with volatility more active, I just prefer to use more credit spreads at the moment. All right. So if you have any questions on markets that I have taken a look at here today, let me know. If you have any other markets that you'd like me to take a look at, type in those symbols now. Otherwise, I'm going to start to wrap up here for today. I will be back on Friday as we wrap up the week for our weekly recap. We'll take a look at some of these markets again to see what happens between now and then. If you have any questions between now and then, feel free to leave a comment here on the video, here on YouTube or on our blog, or you can email me directly. Mike@netpicks.com is the email address. So enjoy the rest of your day, guys. Hopefully it was beneficial to do one of these here pre-market before the market opens. Good luck with your trading today, and we'll talk to you guys on Friday for our next live session.